Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, March 1st, 2023. Hope everybody's having a fantastical Wednesday out there. It's hump day. Not the best day in the markets again. The Dow managed to finish in positive territory just by a little bit, but the other two major indexes here domestically, not so good. But again, not surprising. So if it's your first time watching, please give me some big old likes, shares, thumbs up, subscribes, follows, all that good stuff, regardless of where you're watching this. Let's go ahead and jump into the numbers and see how things did today. The Dow Jones was up 0.02%, closed at 32,661. S&P 500 down 0.47%, closed at 3951. NASDAQ down 0.66, closed at 11,379. VIX fell 0.58. It's at 2058 currently. Canada was up 0.19. Brazil down 0.52. Mexico up 1.36. European markets, Germany was down 0.39, UK up 0.49, France down 0.46, Netherlands down 0.47, Spain down 0.76, Italy down 0.59, Switzerland down 0.38, and Portugal down 1.44%. Russian exchanges both in the green today. MOEX up 1.18, RTSI up 1.01%. And the overnight in Asia, Japan, the Nikkei was up 0.26, Australia down 0.09. In China, the Shanghai was up 1%, the SESC component up 1.11, China A50 up 1.36, DJ Shanghai up 1.02, Hang Seng up 4.21%, and the Taiwan weighted up 0.61. So it looks like the overnights are pretty good, but Europe and here domestically, not quite so much. All righty, let's go ahead and bring up the market recap. Dow wins flat as rates jump on signs, disinflation losing steam. Notes here, so I sound somewhat intelligent when I speak. All righty. Today, the Dow Jones Industrial Average closed flat, with Treasury yields continuing to advance amid signs that disinflation in goods has ended. This trend suggested that the Federal Reserve's interest rate hike path may be steeper than expected. The February Institute for Supply and Management Manufacturing Purchasing Managers Index, PMI, increased slightly from 47.4 to 47.7, but a closer analysis of the data revealed new evidence of price pressures. Jeffries noted that the prices paid index of the ISM manufacturing report rose from contraction to 51.3, indicating that the disinflationary trend in goods that has been in place at the end of 2021 had run out of steam. These signs of sticky inflation fueled bets that interest rates will need to remain high for longer to contain inflation. The 10-year Treasury yield reached 4% for the first time since November, with tech stocks remaining under pressure and continuing their slump from February. Lowe's companies shares fell nearly 6% after the home improvement retailer reported fourth quarter revenue that missed Wall Street estimates and annual sales guidance that surprised investors to the downside. Goldman Sachs noted that the company's ongoing sales trends were weaker than expected and are likely to continue, with a sharp decline in credit income achieved in the quarter and a muted margin outlook relative to history. Electric vehicle stocks, including Tesla and Rivian Automotive, were also in focus. Tesla was expected to lay out its Master Plan 3 and provide insights into its long-term growth plan during its Investor Day. Wedbush analysts noted that this next master plan would give further insight into the company's broader strategic roadmap for the next decade as the green tidal wave hits the global economy on the shift to EVs. I personally think it's going to be a gigantic disaster with these electric cars. I think they're going to be all over the place because the cost to replace the batteries is going to be more expensive than most people think. Rivian EV maker, rival EV maker Rivian reported mixed fourth quarter results, with revenue missing estimates and annual production falling short of Wall Street expectations, sending its shares down more than 18%. Finally, 3M Company, a major Dow component, gained more than 2% after the data from the Department of Defense records show that the vast majority of claimants in combat arms earplug litigation had normal hearing. So, hey, so they're saving money. I know the hearing aids the earplugs I used to wear in the Navy, well, I didn't wear them a lot, so that's probably why my hearing sucks at this point. And all the loud rock music I listened to as a teenager in my Walkman. All right. Well, next up, healthcare will cost more than most retirees have. Here's why Medicare isn't the answer. So let's see what has to be said here. According to a study by the Employee Benefit Research Institute, healthcare costs in retirement will be more expensive than the savings of most Americans. The study shows that even with the coverage offered by Medicare, retirees should expect to pay significant out-of-pocket costs for their healthcare during retirement. These costs cover a range of expenses, including insurance premiums, program deductibles, and prescription drug treatments. The study found that even with the supplemental insurance, on average, men will need $166,000 in dedicated savings to pay for their healthcare needs in retirement. For women, the longer expected lifespans, that number climbs to $197,000 and an average of $318,000 for two-person households. These are large numbers on their own. What makes the findings even more stark, however, is how they compare with how much people have in total savings. The median household at retirement age, 65 or older, has $87,725 in total savings. Not good if you're going to plan on retiring. This is less than half of what someone would need for their healthcare spending alone. Medicare has a reputation for simplicity, but it has never provided comprehensive health insurance. Instead, it has always been a patchwork of options focused on paying for hospital stays and the occasional doctor's visit. Most households cover this through a combination of supplemental insurance, Medicaid, and employer health insurance plans. Together, it makes for a potentially expensive network of premiums and out-of-pocket spending. Arguably, the single biggest detriment of costs in which version of Medicare someone enrolls in. The program has two versions, known as Traditional and Advantage. Traditional Medicare includes hospital stays, doctor visits, and some drug costs, Parts A, B, and D, respectively. It covers fewer services and includes more out-of-pocket expenses, but it's also accepted by virtually all providers. A Medicare Advantage includes coverage that traditional Medicare does not, such as more prescription drugs and dental coverage. It has fewer out-of-pocket costs than traditional Medicare and more caps on overall spending. However, the program is also run by private insurers, which leads to lower payments and higher overhead costs. So Advantage is also accepted by fewer providers. Yet no version of Medicare offers comprehensive health care. From drug costs to long-term care, the program has hard limits. This is why 90% of all retirees have some form of supplemental health plans in place. Low-income retirees can qualify for Medicaid, while other retirees choose to enroll in supplemental third-party insurance known as Medigap. These health insurance programs that cover the costs of Medicare typically omits, and they have premiums ranging from around $130 to $300 a month. All retirement health programs come with additional costs. Even Medicare itself requires deductibles, copays, premiums, many of which come as a surprise to retirees who expect it to provide completely free health insurance. Supplemental insurance requires out-of-pocket costs. Most Medicaid programs require some form of patient contributions. Often a retiree will need treatment that no program covers. As healthcare gets more expensive, lifespans get longer, and both employers and governments consider cutbacks to traditional benefit programs. Many households will need to prepare for health insurance to consume most of their retirement account than they ever had before. So guys, set aside your nest egg, because life's going to get more and more expensive down the road. So, and we may not have Medicare moving forward, because the program's going to run out of money in just a few years, and the fools in Washington have no plan to fix it. All right, last up, Fed's original mouthpiece Shatters strong labor market propaganda casts doubt on job openings. So let's see what that has to say. According to an article on Zero Hedge, data from the U.S. Bureau of Labor Services has been exaggerating, with the official number of job openings being incorrect and exaggerated. The BLS has also misreported the number of layoffs, with layoffs being far higher than reported. This is due to the flawed seasonal adjustment metrics used by the BLS, which have been influenced by the Biden administration's unwillingness to admit that the true state of the labor market. The article reports that virtually every labor market metric, from unemployment to payrolls, has been skewed to represent a stronger economy. Recently, data from ZipRecruiter and Recruit Holdings, two large online recruiting companies, showed that the number of job postings is declining more than the BLS reports. This has caused investors to lose faith in the companies with disappointing earnings reports. The misreported data from the BLS is a significant concern, as it has led to the belief that the U.S. economy is overheating, fueling high inflation. The Federal Reserve officials believe this to be true, leading to interest rates being raised in an attempt to slow growth and reduce price pressures. If the BLS reports move in line with the recruitment business, Federal Reserve officials could feel less pressure to move aggressively. The Labor Department will report job opening figures for January and payrolls for February next week. The December tally recorded 11 million available jobs, 57% higher than levels in February of 2020, right before the COVID-19 hit the economy. The number of available jobs ticked up in December after drifting lower in earlier months. Private data also point to a decline in available jobs. The National Federation of Independent Business, which represents small businesses, and LinkUp, a research firm that tracks job listings that companies place on their own websites, also show a sharper drop in postings than recent government reports on openings. There has been a surge in job seekers in the market, and when there are fewer jobs, it takes longer for these job seekers to find work. The truth about the labor market is essential to understand, and as the BLS is faced with the dilemma of admitting the actual state of the U.S. labor market and reducing upward pressure on the stock market, or keep pushing the lie of economic growth, leading to a potential market crash. All right, so seems like the Bureau of Labor Statistics has been a little fudgy with their numbers, but we shall see what happens moving forward now that they've been called out. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a fantastical evening, and I'll talk to you next time. Adios.